Hybrid sales. What I'm going to do is get into some numbers to show you that how a hybrid sale can actually give you, based on current rates, less tax than a sale of shares without the capital gains exemption and an asset sale. So what we're doing is that we're selling the major asset goodwill, but the vendor, so what's happening is the purchaser is going to depreciate it, vendor gets low corporate tax and gets CDA. Vendor also gets to claim the capital gains exemption. So we're doing a partial sales share on part of his shares, and we're going to do the asset on the rest. And it's very important because the timing becomes critical with this. It's very critical the timing has to be done properly. And it's very numerically oriented. And like I said, this type of transaction is, and the asset sale transaction, numbers, if we do this course next year, will change. So it's a limited time offer only. Here's my example. I have an FMV of 2.8. I have equipment, FMV, ACB, UCC equals 800,000, goodwill is 2 million. Assume no debt, Mr. X and purchasers deal at arm's length. Step 1, Mr. X sells 800,000 of his Target Co shares to purchasers for an $800,000 note. Okay? Then Target Co sells proprietary technology to purchasers for $2 million cash. So now what happens is purchaser redeems its shares on Target Co in consideration for equipment for $800,000. So now if we look at this, there's $2 million cash in Target Co, $1 million CDA. The $800,000 cash, let's say, was additional cash sitting in Target Co or borrowed, whatever. It was moved up to purchaser, and then in step 4, purchaser pays off the promissory note to Mr. X. So you look at the diagram, Mr. X gets $800,000 cash, $2 million cash is sitting in the hold in Target, which is now a hold co, $1 million CDA, which is triggered on the goodwill, $800,000 equipment that's been moved over because the cost in FMV and UCC in my example was the same. And you have a proprietary technology that the purchaser, because it's arm's length, has paid $2 million for and has a basis or a cost base of $2 million. So if you work the numbers out, we paid corporate tax on $2 million on the goodwill. The equipment, there was no tax because FMV and UCC and ACB were the same. You have a $1.735 million left. Pay out $1 million CDA. You have a $735,000 cash available for shareholder distribution. Let's assume it was just the whole thing is eligible dividends at 33.85%. It's $248,000. Your net in your genes is the $486,202, the $1 million CDA, and the $800,000 he got tax exempt. Assume no minimum tax. So what we have is $2.286 million in his net cash in his genes. We divide that by 2.8 for the cash retention is 81.66%. So I do my math right, it's 18.34% effective rate. What's your capital gains rate without any exemptions? 24.77. So I've effectively given you a lower rate, the vendor the lower rate. Forget about the capital gains exemption for a second, because that, we don't know how could that skew it, because we don't know what the number is. I've given you a lower rate than the capital gain. Asset sale is the same thing, except that you're having the $800,000 additional proceeds is coming at the corporate level, not the personal level, because he's not getting it. You have $1 million CDA, again on the goodwill, left with $1.53 million cash available to shareholders, $519,598 eligible dividend rate, left with $1,015,000 plus the $1 million CDA. Net cash is $2,015,000. Divided by 2.8 gives me a 71.98% cash retention rate, which is 28.02 effective rate. So if we just summarize this, you got 18.34 hybrid, 24.77, and 28.02. Which one do you like? Loaded question. Which one would your client like? Which one? Hybrid? I'd ask the quiz question, who's your client? If your client's my father, if my father's sitting in front of you, what do you think, which one would he like? Which is the more aggressive one? Pardon me? Does my father like aggressiveness? Even though he's ironically a tax lawyer. No, he doesn't. So which one would you tell my father? My father likes simple solutions. He wants a simple, low complex solution. Share. probably he'd go for the share. He goes, I don't want to bother with hera-fairy stuff at all. And they're going to change the rule. What he's afraid of with the goodwill, he thinks they're going to go retro. Because he thinks, oh, you know what, Manu, they'll go retroactive, and then you'll be screwed. And I'm like, Dad, they don't usually go retro. More sophisticated clients would like the hybrid. What my point is that I'm not proposing a hybrid solution to a client who's two things, cheap and stupid. I will not do it. Because if they're cheap, they're going to want to bargain me, and I'm not bargaining them on a hybrid because a hybrid is more complex. They got to pay fees. So, and if they're not sophisticated, remember, at the end of the day, who takes responsibility? We have to let the client take the responsibility. And if they're too dumb to understand the risks, because there is a little bit of risk here, then I'm not going to do it. I go with a share or even an asset. Probably the share sale. I agree. The share sale is the cleanest one, if you can get it. Again, depends on who the client is. Limited time offer only on goodwill sales. Because the budget, it is not law yet. It is a proposal. But we can only assume.